Hello, Alexander Green here, Chief Investment Strategist with the Oxford Club with another market update. And I want to remind you that if you don't already subscribe to this channel, please click on the link below and sign up so you don't miss a single one of them, because I've got lots of great information I'll be sharing with you over the next several weeks. Today, I want to talk about a particular type of investment that most of you probably don't even own. They're called real estate investment trust, or REITs for short, R-E-I-T, REITs, real estate investment trust. This is simply a securitized way of owning commercial real estate. If I were to ask most of you, do you own an apartment building or a warehouse or an industrial park or a shopping center? Your answer would almost certainly be no, because those investments have traditionally only been available to very wealthy individuals. And even if you aren't that wealthy, borrowing enough money to buy a shopping center is still out of the realm of possibility. But just as you can own a diversified portfolio of stocks in a single share of a mutual fund or an ETF, you can have a diversified portfolio of commercial properties, income producing properties, with a very small amount of money if you buy a REIT, or to get that diversification, a mutual fund or ETF that specializes in REITs. Now, the question is, why would you want to own this type of investment? Well, first of all, we're in an inflationary period. During inflation, real estate related assets tend to do very well. The problem with owning real estate for most people is that you have a very high cost, a lot of borrowing, and then you have property taxes and maintenance and repairs and homeowners insurance and other costs, often unexpected, that tend to be a drain on your cash flow. But again, if you own a portfolio of real estate investment trust, there's a manager who's overseeing not only the portfolio, but there's managers overseeing those particular properties. So you have none of the muss and fuss of owning commercial real estate yourself, and they're a great hedge against inflation. They're also a great portfolio diversifier, because if you have stocks in different types of companies like banks and retailers and manufacturing companies and so on, you've got some diversification. But if you also own income producing properties like apartment buildings and shopping centers and office parks and so on, you've got a further layer of diversification. And in this very low interest rate, low yielding environment, real estate investment trusts yield about 2.4% right now. And one of the great things about real estate investment trusts is they're not subject to the corporate income tax. And the way that they avoid that is, by law, all real estate investment trusts must pass through to shareholders at least 90% of their net income each year. And so you can count on getting a decent yield from these properties. And then, of course, as the value of the real estate rises, appreciation in the real estate investment trusts themselves. So this should be a component of your portfolio. If you've read my book, The Gone Fishin' Portfolio, New York Times bestseller with a foreword by best-selling author Bill O'Reilly, you know that in that portfolio and in the Oxford Club's asset allocation model, I recommend that you have 10% of your liquid assets invested in real estate investment trusts. So they're definitely a worthwhile hedge against inflation, portfolio diversifier, and generator of capital gains and income. So I want to thank you for watching and remind you that all of my views are available every week for free in Liberty Through Wealth, my free e-letter. So just go to libertythroughwealth.com and you can sign up and receive all my market commentary. So again, this is Alexander Green. Thanks so much for watching.